Check, mic check.
Mic check.
Welcome to Making Sense of Wealth with Andrew Whalen, your personal CFO, the show where we break down complex financial topics and market events into investor-friendly concepts so that you can make better informed decisions about your financial future. Because if it don't make dollars, it don't make sense.
Welcome to Making Sense of Wealth, everybody. My name is Andrew Whalen. I couldn't be happier today to have a special guest on. It's been a crazy start to the year with the worst start in the markets in over the last 50 years, and it all comes down to one thing, and that is inflation. So today we've got Dr. Stephen Miller, and I told you that I had to read this bio, so I'm going to read it again. And Dr. Miller has expertise in macroeconomics, monetary and fiscal policy, financial institutions, housing, applied econ metrics, and regional economic analysis. He is an internationally recognized scholar for his work in economics, having published 189 professional papers in peer-reviewed journals and made professional presentations on 156 occasions. Dr. Miller is currently the Director of Research at the Center for Business and Economic Research and Professor of Economics, and formerly the Director of the CBER and Department Chair at the University of Nevada, Las Vegas, where he has resided for the last 21 years. Thank you, Doctor, for coming in today. I really appreciate it.
My pleasure.
Yeah. So there's a lot going on, and the one word that's on top of everybody's mind, and you've done a tremendous amount of research and published papers on, is inflation. So just from a 30,000-foot overview, what's your spectacle look like on the format of inflation, where it kind of stands right now?
Well, I would say that it's not inflation necessarily, but people's expectations about the unknown. People are just too young. If you were my age, you'd lived through the 60s and 70s into the 80s, and you would have experienced much higher inflation rates and much higher mortgage rates. I mean, double-digit mortgage rates. So that the current situation, if I may say, is not tremendously bad. It's not good,
Right.
but it's not. People are overreacting, in my judgment. The Fed has already begun to tighten up, and we're seeing evidence already that maybe we're on the downside.
Very interesting. Carl?
Yeah. I mean, how long do you think it could go on? I mean, people have been surprised so far. They were really surprised last year when, the Fed really had to change direction and had been saying that inflation was temporary for so long. And now it's becoming clearer that it's more permanent, or at least, going on for a while. Our kind of view is that really the Russia-Ukraine war changed things in a big way. I think we wouldn't be here right now were it not for that. But here we are, where you have probably longer-term undersupplies going on in energy commodities, agricultural commodities. We feel like until that undersupply condition gets resolved, we're going to be, in a situation where we've got elevated inflation. What do you think of that?
Well, that sort of opens up several areas of conversation. So let me start first by saying that the Fed is interested in controlling the trend inflation, not necessarily the overall inflation rate. So if you think about the inflation rate, you can divide it into trend and cycle. And the trend is what they're concerned about. So how do they measure the trend? And in fact, how do they measure the inflation rate itself? There's a bunch of inflation rates that are out there in the econ world. Currently, the Fed is targeting what's called the core PCE. So let me unpack that. So the PCE means the personal consumption expenditure deflator, which comes out of the calculation of GDP. One thing to know about the PCE deflator is that it's a fixed price deflator. What most people are familiar with is another measure of inflation, which is the CPI inflation, the Consumer Price Index inflation rate. And the consumer price inflation rate is a different beast in the sense that it's a fixed quantity index. So think about it. The PCE is a fixed price, and the CPI is a fixed quantity. So what about the CPI? How do they measure it? So think of a family living in the urban environment, family of four, husband, wife, two children, or whatever. But in terms of 4 people in the family, what do they typically purchase on average over time? And what the bean counters in DC do is they go out monthly and they collect the prices on that basket of goods. So the basket of goods is fixed. It changes over time, but basically it's fixed, and they collect prices and compute the index. And from the index, we get the inflation rate. And that's what most people are familiar with. And at the moment, the CPI inflation rate is the highest of all the measures that we have. The May rate was 8.5% or 8.6%, something in that range. The PCE is something that is not as well known among the population because it doesn't receive the same sort of press coverage. So when you calculate the GDP, you do two things. One, you calculate nominal GDP. You calculate all of the quantities times prices at a point in time to get nominal GDP. Then you go back and calculate real GDP where you keep the prices constant. So as I move forward in time, the quantities change, but I keep the prices fixed. So I have two series. I have nominal GDP and then I have real GDP. And in the base period, which currently is, I think, 2012, the price will be the same for the nominal and for the real. So the index will turn out to be 100. What happens is you have nominal GDP, real GDP, you take the ratio, and that gets you the price index. So they don't calculate it directly. It's and that's why it's called the implicit price deflator. It's not direct, it's implicit in the other two series that they collect.
Is it more of a stabilized view of inflation if you're using
I
the
would
PCE?
say the PCE has a couple of characteristics. One is it's broader than the CPI because it includes all consumer items in GDP.
Sure.
And it tends to be a little more stable.
Yeah.
But not so much. So the PCE deflator in May, I think, was 6.7%, somewhere around that range. And as I told you, the CPI was like 8.5, 8.6%. But that includes everything. And what the Fed wants to do is measure the trend. So the easy way they get a trend measure is they throw out volatile components, in this case, food and energy. So food and energy are deleted, and you get what are called the core measures of CPI and PCE. And the core CPI was running at 6% in May.
And like 4.5 or 4.8.
I think it was 4.7% for the PCE deflator.
And just out of curiosity, was that measured in the 70s and 80s as well? And just as a comparison, because everyone wants to look at CPI, it wasn't. Yeah, okay.
CPI goes back to 1913.
Yeah,
this is the old measure that's existing. Some of the other series started in the 50s or 60s. It's not right in the top of my head, but I can see my Excel spreadsheet where I have all the data. And data starts here and then it starts here. No, so
it wasn't available then. The PCE,
Well, you want monthly data, right? And GDP comes out quarterly, right? But they do supply the monthly consumption expenditure, although they don't give you the total GDP. You get consumption. So when they do that, you get the PCE index monthly, which is what they're interested in calculating. So I rambled, right?
No, and on a target basis.
That's fine. It's good to know the underpinnings behind how they look at all these, different inflation metrics. So you would say that the Fed tends to focus a little more in figuring out what their path of policy should be by looking at the core PCE because it's more stable and it's a broader measure of inflation than the CPI.
Well, officially, that's supposedly what they target.
Yeah.
When they say they have a 2% target, that's the level they're targeting, not the CPI. But they still have to talk about the CPI because everybody else is talking about it.
Sure.
Right. Everyone's, average person's a little more focused on what's going on with food and energy, even though they like to take that out. But yeah, one of the reasons we really wanted to talk to you was because you had the good fortune of starting your career at the beginning of the 1970s when, we first started to see a lot of inflation in the United States because of a number of things. like the Johnson administration's Great Society programs, the Vietnam War, et cetera, loose monetary policy, but then also the oil price shocks. So we've been looking at that period a lot in trying to glean insights as to how the current environment could go. But one of the things that we've really been thinking about a lot there is, do we really need a recession to reduce this amount of inflation that we see now? Or is it possible that the Fed could be successful with raising the Fed funds rate, reducing their balance sheet, that we could actually reduce inflation without having a recession and having unemployment go up meaningfully?
Tough question.
Good question.
Yeah.
I have a couple of comments on that. So my visual of this is you're flying the brand new jet in the Navy, and you're going to land on the aircraft carrier.
You're Maverick, essentially.
Whatever. And the problem is you don't think you've got enough runway on the aircraft carrier to land. You probably can make it, but you might not. And that's sort of the situation the Fed's in. And some folk would say the reason the Fed's in this situation is because they waited too long to tighten. Maybe that's right, but 2020 hindsight is always good.
Well, I think there's never been a period in time where you've had this significant of a gap between the federal funds rate and where inflation is.
That's true. No.
Right?
If you look at the data, the difference between the funds rate and inflation rate, it's as large a negative as we, I think, in the history that we've seen, that
Right.
at least that I've seen.
Yeah.
So I think that it's possible to engineer a reduction in the inflation rate without causing a recession, but probably not.
Yeah.
Now, certainly what the Fed has to do is they have to raise the unemployment rate in order to be successful in getting the inflation rate down there. The unemployment rate is going to have to rise. It's currently at 3.6%. And historically, going back to 1970 and looking back over to the present, saying 3.6% is an extremely low unemployment rate. And we've lived with much higher unemployment rates and thought we were at full employment,
right,
or high employment.
Yeah,
and this time is different because the labor market is so relatively hot compared to going into recession when you've got 2 jobs available for every worker who's looking for a job. I don't know how long that's going to last, but currently, in the last couple of months, we've had that situation. That's going to support the Fed in reducing inflation rate without causing a recession, I think.
The fact that the unemployment rate is already so low,
and
the jobs available.
I know it's a very strange environment to have that.
Yeah, I never thought of it like that.
Normally the unemployment rate hasn't gotten below 4 very often in business cycles.
In a sustained period of time.
Right.
Have you listened to Larry Summers and his 4%? I forget which one it is. I actually got the data. I think he's prevaricating a little bit on that. I don't see the 4.4. Do you know what I'm talking about?
I do, but I don't think I've listened to the exact commentary that you're.
Well, he says every time I hear him, he sort of talks about 4 and 4, but my memory is failing me on what he's. If the unemployment rate is under 4% and something else is something above 4%, we end up with a recession.
Another leading indicator.
Yeah,
potentially. Yeah, what's difficult is that the Fed's, stuck between a rock and a hard place from the standpoint that they've got to get the federal funds rate up high enough to put enough pressure on the consumer. But if it goes up too high, like it did in the 1970s and 80s, and I think we'll talk about this a little bit later, where they raised the federal funds rate above CPI, they also have to combat the Treasury Department and funding the Treasury Department to make sure that it can stay viable at a higher interest rate of issuing new debt. So, what I would like to talk about is kind of what options are there to control general inflation? I see it coming out of three main segments: consumer demand, supply chain issues, and then energy problems or wars in Ukraine, and now conflicts in Ecuador and Libya, that they may halt production of petroleum as well.
So supply chain, war in Ukraine.
They can't touch that. I mean, they can't fix that.
The Fed can't.
Right.
And COVID in China at the moment.
Yeah, the zero
and other
COVID
places.
policy that they said 5 more years.
You said consumer spending. Now it was retail sales are off, right? And
Slightly, yeah.
Slightly. That's something they can control. They can control the demand side. So the way I like to think about it is the other components have microeconomic implications, not macroeconomic implications. And the Fed is not in a position to really control that. So traditionally, it's fiscal policy and monetary policy. I think my view is, fortunately, we had fiscal ease that came about when the pandemic hit. I mean, the pandemic was unprecedented.
Sure.
So I don't know anybody that lived through the 1918 pandemic.
Yeah.
So I
Sure.
I know people are scrounging and scouring for data to do analysis. I've seen a couple of papers. But the response of the fiscal authorities was pretty robust.
Yeah.
I remember initially if you were out of work, they were going to pay you extra $600 a week unemployment compensation. That's $15 an hour, which is right on the minimum wage. What people are proposing in many states, $15 minimum wage. That's on top of the unemployment compensation they're already receiving if they were qualified for it. To me, that was sort of unprecedented and probably necessary to sustain the demand. So the reason the labor market is in such good shape and might allow the Fed to bring inflation down is because of the fiscal action. On the other hand, the fiscal action probably explains some portion of the inflation rate. It's not all microeconomic supply chain war in Ukraine and COVID. Some of it is the expansionary effect of the fiscal authorities and the monetary authorities. Mm-hmm. The Fed kept the rate extremely low. The real interest rate is very negative at the moment. I hope we're going to talk about that.
Oh, we will. We'll get into that.
Yeah. And we're just getting warmed up.
Okay.
Well, we're just covering the basics right now. One thing that I wonder about too, and I kind of doubt, and I think a lot of people doubt, is when Jerome Powell says that we're going to get the inflation rate back to 2%. Can that really happen? Can that happen easily? Can they do that given everything that's going on? Or do we really need to, have a recession and have these commodity undersupply issues fixed longer term? I think a lot of people doubt that, but do you think that if they navigate it properly with raising the Fed funds rate, reducing the balance sheet, do you think we could actually get back to a 2% inflation rate, before getting into a recession? Or do you think we'll really have to have a recession to get back to a 2% inflation rate?
And I don't think I'd place any bets on it one way or the other. What I do know is that the long-term inflation expectations is consistent with that happening.
Right. That's a key thing right now, is that while the bond market has reacted a bit in the last few months, it hasn't gotten out of control. And one of the important reasons for that, and something that we've looked at and written about a lot, is just the level of debt that's out there in the economy after, not just in the federal government on their balance sheet, but also in the housing market.
The banks, the consumers, the businesses.
Yeah, the bank balance sheets and consumer balance sheets are in much better shape than they were, say, 10 or more years ago. But one thing is that after all of the stimulus and then the housing prices going up and then people, continuing to buy houses with mortgages, the level of debt in the federal government, the Treasury holds is 40% higher, or has outstanding. It's 40% higher than it was before the pandemic. And same thing with the housing market. So one of the things we've looked at there is, how much pressure increasing interest rates will put as on their balance sheet and their income statement as they refinance, because there probably is going to be maybe $4 trillion in tax collections this next year. It might be on the way down given everything that's going on, but the government interest expenses, we expect it to go up about 30% or so this year, because a lot of it, over 80% of it, is short and intermediate term, and the yields on those treasuries have gone up a lot. And as they get refinanced, then the government interest expense will go up. So we think that's something that will end up slowing the economy. But it really comes down to, what happens with inflation. There comes down to like, what is our, like, politically and as a society, what's our commitment to really reducing it? And we think that given that people are voting, we can elect leaders and get rid of politicians if we don't like the outcomes. We think we're probably on a good path there. But a key thing, the reason I talked through all of that is, going back to something that Andrew was saying about, where the Fed funds rate really needs to go, and why we wanted to talk to you, because we've spent a lot of time looking at that, how that worked in the 1970s and 80s. And there are people out there who say that you really need to get the Fed funds rate above the CPI, because if you don't
have real rates,
if you don't have positive real rates, you can't really kill inflation, because there are a lot of people out there who are borrowing money, and they, for housing or whatever it might be. It could be a business loan, and they look at that and they say, well, if I can borrow for less than the inflation rate, I'm going to do that as much as I can. So that's why some people say that you have to get the Fed funds rate above the CPI, but that's not necessarily something to be scared of, because as it happened in the 1970s, there, like Andrew was saying, there were big gaps between the Fed funds rate and where longer-term Treasury yields were, because inflation expectations and the global market for treasuries kind of sets the longer-term yields, unless the Fed is going to get in there and do aggressive yield curve control, which they probably can't at this point, given that they are committed to unwinding the balance sheet that they have there. So we want today, and it could always change.
Do you think that we need to get the federal funds rate above the CPI? So, I mean, I see in a perfect world, as the Fed continues to raise the federal funds rate, it's going to continue to slow down the demand from the consumer. I wouldn't be surprised if you saw an 8 number on CPI in the next, 2 weeks or so. But it could be higher, just to double check that side of the coin. But if they have to get the federal funds rate that high to really dampen inflation like they did in the 1970s and 80s, wouldn't that mean unemployment would be in the 7s or 8s? Like it was.
So first, I think your expectation about the CPI inflation rate may be wrong.
You think it's higher?
Right. Lower.
Think it'll be lower than 8 in June?
I think it'd come out lower, or at least not going up. But I could be wrong.
Sure. Yeah. But even if it is, let's say it stays the same.
The answer to your question is yes. It's got to be above the inflation rate. Otherwise, you're not tightening.
So
they're being aggressive about tightening.
Yeah.
And you guys both have you just visited St. Louis? Have you been there recently? Is that
no? Why? Oh, because the Fed.
Oh no, we just like the St. Louis Fed's work.
Well, in this case, I do too. I think Jim Bullard is on target. Did you read his stuff on this?
Yeah.
Yeah. So he's looking at 70, 73, 74, and
81, 83.
Early 80s.
Mm-hmm.
He has a pretty persuasive argument, I think, having lived through that myself.
Sure.
The 70s were bad news. That is, and his argument is, as you know, that the Fed really didn't get serious, and the real rates remained low throughout that period, and inflation just continued to be a problem. It got worse and worse.
And maybe in a perfect world,
Interestingly enough, we had 2 oil price shocks.
right?
Of course, I'm taking the other side now. Two-handed economist. There was an oil price shock,
Two-handed
73,
economist.
74, and then an oil price shock in 79. Then we had two oil price shocks in the 80s, but they were the other way.
Right.
So
And we had
his argument is if I layer it, I see that the oil price shocks sort of help his argument.
Mm-hmm.
That is, the inflation rate came down in the 80s, partly because of the oil price shocks were negative shocks, not positive shocks. And in the 70s, the oil price shocks were positive shocks, not negative shocks.
And if we don't have a deep recession, if it's, you see a lot of talking heads discuss, hey, this could be a mild recession. I don't think if we don't have a deep enough recession, you're going to shock demand enough to actually bring oil prices down, even if it alleviates itself at $70 or $80 a barrel where it was prior to Ukraine.
Inflation is a continuing change. And sorry, I'm being Uncle Milty now.
It's okay.
It's a continuing change in the price. So the oil price goes up to $120 a barrel.
Yeah.
You got to go up to 150, then 180, then 300, and
sure.
If it doesn't do that, then it's not going to be a part of the inflation rate. Now the oil price will still be, it'll still be high, but real oil prices, I think, you'll correct me on this one, Carl, right? The real gasoline prices are lower now than they were not too long ago.
Right. Well, that's kind of the history of commodities, that you have technological advances and
like
the
WTI,
real prices.
Oil prices. Yeah, I think it topped out at 122 in June.
Right.
Beginning of June. Now it's 107.
It got up to
105.
140 in 2008.
Mm-hmm.
I'm thinking deflated by the CPI or whatever deflator you like, and look at it over time in real terms, and you'd find that maybe a decade ago it was even much higher than it is today. But I could be wrong.
That's right. You're right about that, because I remember it was
and just people have short memories, right?
Yeah, and that kind of brings back to how you started it out, where you were saying that it's not as bad.
This old fart comes in and tells us, "Don't worry." Me worry? Alfred E. Newman.
Yeah, right. Alfred E. Newman. So we're in a position where obviously the consumer is feeling the pinch at every turn, and the Fed is only making it more difficult to buy the only asset class that represents a miniature economy, which is housing. And I just don't know how much demand destruction you have to create in, let's say, an asset class of housing to get the Fed to back off the pedal, right? If we've got the different components of CPI or even PCE, and how much do all of those different components have to come down for the Fed to say, okay, like, does housing have to go down 20 or 30% to make a significant impact on inflation?
It doesn't have to go down. It goes up slower.
Yeah.
So
just time.
Economics of growth.
Time.
It's lower inflation rate doesn't mean the price is coming down. Price is still going up. It's going up more slowly.
And how about the PCE?
Same
situation.
Yeah.
Well, we'll see what happens with what they have to do with the Fed funds rate. But we have been kind of the mindset that, that's why we wanted to ask you that question and talk to you, because that's something that we've really been thinking about a lot. One of the things that we thought could happen there was that, because we're also a fan of the flatter inverted yield curve as a recession indicator, and Campbell Harvey's research he's an economist at Duke University. You're probably familiar with his research on all of that. We've felt like one of the key things, that's one of the key things that you see before every recession, when the yield curve gets flatter, inverted, that slows things down. Even if you've had a lot of bad lending, like in the 2005 to 7 period, because until that happens, the bank lending doesn't really stop. But once you flatten or invert the yield curve, banks don't like to lend as much anymore because they don't have a net interest margin on new loans. So maybe something that happens here also is that they raise the Fed funds rate enough to flatten or invert the yield curve, and then the economy starts slowing and then inflation starts slowing also. So maybe they don't have to raise the Fed funds rate above the CPI, but it's an open question for us. If they had to, it might scare people, which is why we're thinking about it so much.
So my thought would be the yield curve is an excellent predictor of recessions, and
And can you explain that, Doctor? Why it tends to be a really good indicator?
Because if it's inverted, it depends why it's inverted. So if it's inverted because inflation is high now, people don't expect 8.5%, 9% inflation to continue off into the future, right?
Right.
So they expect the inflation rate to come down. So that means that the Fisher interest rate equation, with a lowering inflation rate, assuming the real rate doesn't change very much, that the interest rate is going to come down in the future, and therefore you get the inverted yield curve. Of course, there are other factors like liquidity premiums, risk premiums, and other things that you could throw in to make the model more complicated. But the basic idea is, if inflation is high now, people anticipate it's going to come down naturally, or because the Fed intervenes and causes it to come down, and therefore the yield curve is inverted. Now, Carl, you said that if the Fed increases the Fed, I think if the Fed inverts the yield curve, it doesn't mean anything.
Mm-hmm.
That's just my personal view.
Talk about that.
Because it's not an economic event. The Fed is artificially raising the short rate to invert the yield curve, right?
Mm-hmm.
So what? Okay, it's not so.
Will that impact bank lending though?
Well, I'm trying to recall when it happened. Within the last 5 years, that did happen.
Right. It last happened in 2019, in the summer of 2019, and that was a unique thing. The way it happened was unique because in the past, when we've looked at it, it seems like the yield curve is flattened or inverted, the year or so before a recession because the Fed raised the Fed funds rate. But what was unique about 2019, some people say because there was so much debt in the world and so much quantitative easing done in the prior decade, that it didn't invert in the summer of 2019 because they raised the Fed funds rate. It inverted after they did the first rate cut because the long end fell so much right after that happened. So that was a unique thing. And we've been thinking about that and watching for behavior like that this time because, look, we have even more debt and even more aggressive QE done in the last couple of years.
I need to hit the back of my head, get the file cabinet open. I do recall talking about that. My explanation was that we didn't have a problem because the Fed raised the federal funds rate. So, but you said that was before but it's all a timing issue. Who knows what the timing is, right? Is it 9 months? Is it 12 months? Is it 18 months? But if any of these models that forecast recession, if they don't have the term structure in there in some form, the model will not work as well. The models that only have the term structure in there do a pretty good job of forecasting recessions.
Well, we're pretty interested in things like the yield curve flattening or inverting as a business cycle timing method, but we're also interested in things like the St. Louis Feds. Again, their smoothed recession probability. I don't know how familiar you are with that and the research behind that.
You asked me about it, so I looked at it. So I'd have a couple of comments. One is that model is looking only at contemporaneous variables. So
right, so they can't tell.
Yeah,
they can only tell like a few months later what the probability is.
But even there, it's more than that because the data come in with a lag.
Right, so it can get revised.
And if you really want a forecasting model, you need to use leading variables rather than coincident variables. So they have non-farm employment. They have
like LEI.
Yeah.
Right.
But as I said, in the LEI, you're going to have your term structure, some sort of term structure variable. And I seem to recall, and the reason I mentioned John Sylvia, is he was very adamant about people at one point in time were using the 10 5-year spread. And he was very much opposed as a ridiculous variable to include. He was always for a 10-1 or 10-3 months spread as measuring the slope of the term structure. Anyway,
Right. A lot of people like to talk about the 10 minus 2-year spread, but really, but we've said that really, yeah, like you were saying, the 10-year, like 3-month or very short term spread is more important. And I feel like the reason for that is that most of the bank deposits are at the very short end. So it better captures what's actually going on there with the willingness to lend.
So, Steve, if you were the head of the Fed right now, what would be the most important issue that you would need to address before the end of the year? What would be the most important? From a macroeconomic standpoint, what's most important to Federal Chairman Steve?
I don't think I have much of a difference with their current thinking. It's inflation. I suppose the issue there is how much and how fast to do it. I mean, when I teach my students, I say, well, you have a couple of options. Let me illustrate either what Volcker did, which was
ouch.
You have heavy intervention for a short period of time, or you take the gradualist, you drip forever. And my point of view is the let's have a lot of pain for a short period of time is probably better than drip, assuming. And maybe we've exhausted our capacity to do so at this point in time, assuming that you have the safety net there for people who are in serious problems when you
cause those
you slam on the brakes,
right?
Yeah,
it's unfortunate, right? The people who pay the biggest consequence are those same individuals to solve the problem of inflation. Any thoughts on that?
I'm not sure this is directly addressing your question, but it popped into my mind as you were talking for some reason. People are not stupid.
And do you feel that
the evidence of that we just saw recently is that when the government started providing additional support during the pandemic, the savings rate went from about 8% to 18%.
Right, skyrocketed.
People were, but it's the same. What I teach in my class, I say, when people get an income increase, they evaluate whether this is permanent or temporary.
Yeah.
And if it's temporary, they don't spend it. They
Interesting.
save it.
Interesting.
Professor Miller, I pay off a debt. That's saving. When you pay off your debt, you're saving. Remember that. But they saved a lot of money.
And then 2021 came, everything opened up, and
they started spending it.
Right.
But they didn't spend it all immediately. But I think maybe that I haven't looked at the data recently. That may be exhausted.
And do you think
the population may not be willing to consider any additional spending along those lines if the Fed causes problems?
Right. And do you feel that a good way that states can help solve those issues is issue out stimulus checks in the case of California?
Oh, well, stimulus checks, my favorite topic. Every president
California though, but I know. Look, I agree with the thesis of issuing those out in COVID in a unique circumstance. But now we've got a state like California that just recently announced stimulus programs to help combat high prices. And to me, just academically, that doesn't seem the right thing to do.
What people will do is they understand this is not permanent stuff.
So they'll save it.
They might, I think the evidence is, somebody check me on this. I think the evidence is around 20% of the stimulus checks. So every president comes in at some point, one day maybe she will actually, they come out with these checks because they want to stimulate the economy. They get about 20 cents on the dollar stimulus.
Right.
The rest goes into largely goes into paying off debt, which is good for their portfolio, but it's not good for stimulating the economy
Sure.
directly. Eventually it does, because you pay off your debt, the money goes somewhere and it finances something else.
Mm-hmm.
Because that's your bailiwick, right? It's not my bailiwick.
Yeah, I think that in general, if you look at over like a market cycle of 3 to 5 years, I think the majority of those dollars are probably spent. But I didn't think about it that way. Even if they are saving it in the form of paying off debt, but that money does recycle through. I just don't know if throwing more money at a problem actually solves slowing down inflation. I think the unfortunate consequences of overstimulus and easy money supply or easy money policy over the last 2 or 3 years is a fairly large recession to dampen consumer spending.
Right. You really have to solve the undersupply constraints.
Yeah, you would have to have such a great change in either the supply of energy products or the problems in China, or even the inventory problems, which we're starting to see some resolution in inventories where companies ordered too much. Now they probably learned that lesson real quick, especially if their stock dropped 30% in a day. But you'd have to have those other variables change at such a dramatic pace versus what the implication would be if the consumer just stopped spending as much because unemployment went to 5 or 6.
Well, we just went through that with the pandemic. That is, demand collapsed,
Mm-hmm.
and people said, cancel those orders. I don't need the inventory.
True.
For 2 months, after the Great Recession, employment went from 130 million people at the trough after the Great Recession. We had the longest expansion in recorded history, which goes back to 1850s.
Right.
And we got up in February of 2000. So the trough was February of 2010. And in February of 2020, we had 152 million workers.
Mm-hmm.
So an increase of 22 million workers. In 2 months, they were all gone. We were down to 130 million. You lay off 122 million workers, that's a tremendous hit to the economy.
Right.
And we know in Las Vegas it was even worse because they shut down the casinos and people were laid off, and the economy, the data we follow, it was up like that, boom, went like this. But the interesting thing is 2 months later, boom, it came back about 50% of the way, came back. And then it sort of went sideways for about 9 months. Then boom, it went up again. Went sideways for 9 months. Hopefully I don't hit you in the face. Then up again. So I call that the broken V ranch. Boom, boom, boom. Broken V brand.
Sure.
Can you imagine inventory? You can't imagine inventory control under those circumstances.
Of course.
The guy's going crazy, or gal's going crazy trying to figure out what to do on inventories. And that's why we had we still have the problem. And now we hear that, I don't know that Beijing and Shanghai are actually open yet or not, or they're closed down. It's just a mess.
Yeah, I mean, some people dispute why they're closed. Are they really trying to prevent COVID, or are they just trying to frustrate Western supply chains?
Either way, it still hurts.
If they're doing the latter, they're hurting themselves too.
That's right.
Because they need the dollars for the money.
What happens if the Chinese sell off all the treasury debt? They're going to kill themselves.
Right.
Right. I mean, that was one of the reasons why I thought the Russia-Ukraine war wouldn't turn into something really huge, because the world is a lot more globalized today than it used to be. And countries have risks and costs with military action that, and not as much upside. So it's harder to really rationally justify that kind of stuff. But all of these reasons here, the fact that we're spending to try to solve problems, and there's a certain inefficiency with that. That's also why we believe longer term there's a deflation tail risk out there, because while we're doing all the spending, we're not really addressing the fundamental undersupply issues that are out there, and it'll just take time to address those things. But some comments that you both were making about the Fed funds rate and what could happen there, if Steve, if you were the Fed chair the rest of this year, it reminded me of a really important thing that we've also been thinking about, that what's the likelihood that they could over tighten, now that they've been late. A lot of people are worried about that, because you don't really see the effects of what they're doing now for maybe like a quarter or two. And it reminded me of some really interesting research that we saw a few months ago from some people at Societe Generale, where they were looking at historical information on what had been done with the Fed funds rate and quantitative easing, and people have written papers on the shadow Fed funds rate. What's the effective Fed funds rate, when you do a lot of quantitative easing, because you can't lower the Fed funds rate below zero. And looking at how much easing there had been over the last decade and how much tightening there had been, and they could only tolerate about 70% as much tightening as easing in 2018 and 19. And so assuming that you could have about that much this time, they figured that the Fed really can't afford to raise the Fed funds rate beyond 1%. So we were looking at that thinking that, that means that we're headed for a big bear market right now. And this was a couple months ago. But we felt like, that couldn't really happen yet, because you don't really feel the effects of all the quantitative tightening until they actually get it going, and they just started and they're going to do more. But it takes time. So they had it all figured out, like how many basis points of tightening was what they were going to do in the summer going to be worth, and maybe they could do 500 basis points total between backing off of quantitative easing and doing quantitative tightening, and then also raising the Fed funds rate, which only allowed them to get to like 1% on the Fed funds rate. So that's one of the things that we're thinking about right now is, how much more can they really raise? Because if they go through with doing another 75 basis points at the end of July, we could get another reaction like we had in June. And at what point would they potentially back off? And,
or can they?
And can they? Because, we're really trying to fight inflation. They've been saying, we're committed to that. So that summarizes right there the challenging situation that they're in.
Well, I had several thoughts going through my mind as you were expressing your views. If we go way back to the 70s, Milton Friedman would argue that the lags in monetary policy are long and variable, and therefore let's just handcuff or tie the hands of the Fed behind their back. Don't let them do anything. Let the computer generate the growth in the money supply, and then we'll be much better off than letting the board do, or the FOMC to do their perceived job.
How do you feel about that?
I think it's an interesting story. I don't think it's any relevant any longer.
Right.
And I'm racking my brain trying to remember the acronym now. But are you guys familiar with the new rule, the BIS rule? Also, I think the U.S. adopted it on having enough liquidity credit ratio
for banking institutions.
Yes.
Yeah.
I think that changed the whole game.
Yeah, of course. Well, it required the banking institutions to not only take less risk, but also keep more money at the Fed, right?
Well, that's why the reserves are like $2.5 or trillion dollars,
right?
When they don't have any reserve requirement, zero reserve requirement, and they're holding 2.5. Why are they holding? Well, they would hold reserves in any case, but in this case, they have this quantitative. What do they call it? There's an acronym anyway, and that's to hedge against a bad outcome for 30 days, right?
Right.
And that's why in my judgment, that's why the reserve base has increased so much, and we haven't seen the inflation that's come out of that. The monitors are still saying the same old story, but I think the old story doesn't hold true anymore. I haven't had time really to sit down and try to work out the details in my mind.
Have you thought about the ramifications of the significant amount of debt that we've incurred over the last,
because that's where all this
24 months?
that's where all this new analysis comes from, because the fact that we have so much more debt in the economy now, we've had to do a lot of quantitative easing, and the debt to GDP went from 80% to 120%, but in the 70s or in the late 60s it was 40, and it actually ended at 30 because they had a lot of inflation, wages were able to go up, and tax collections were able to go up.
Japan is like 250.
Right.
So I don't know if there is a story on that, though.
Yeah, I think I read something about Japan, which I thought was fascinating, because I think their inflation rate's only about 2 or 2.5 right now. And they just said, when prices go up, our consumers just don't buy anything. They just stop buying. Other than the essentials that they actually have to live on.
They save to spend.
They save to spend.
We had 2 decades of not being able to generate 2% inflation.
Yeah.
But I lived through the period of time saying, "Oh, you can't generate inflation. What's going on?" But that's what was in most people's memory. So now that we get 8% inflation, they're really concerned about that.
So what's the number one cause of inflation persistency, Steve?
Because as I said earlier, inflation is a continuing increase in the price level.
So you're saying is once we get into, let's say, maybe September, October, November, when we were already judging inflation at, roughly 7% for the end of last year, the rate of change year over year is going to be a lot smaller, so the inflation will naturally come down. People will just be predisposed to high prices.
I'm not sure I don't think I'm saying that. It is true in growth theory that if you're small, you can grow much more rapidly than if you're big. So China's growth rate is never going to be what it used to be.
Sure.
Because they're too big.
They went through
now.
that period already.
Yeah.
But with regards to inflation, and correct me if I'm wrong here, I'll just make a statement. So if we had 7% inflation of December of last year, we've got 8% inflation right now, which is a year-over-year change from June to June. And as we get closer to the end of the year where we had those higher CPI prints, inflation should naturally come down over that period of time as long as no big inputs influence that, because now we're comparing it to the 7% in December.
Yeah, that's true.
And then it's just consumers getting used to paying the higher prices. And even though the CPI then, if it was 8% in December, would only be a relative change of 0, they're just paying, roughly 8% higher prices. See, that's where I think it becomes a little bit more of a problem, right? Where individuals, consumers, aren't getting. I mean, you had the Great Resignation for a large number of people, but they're not getting the 8%, 10%.
Great reallocation or great restructuring. I like to say it as restructuring. There was a nice little piece that the St. Louis Fed put out in Twitter today that compared resignations, quits, and asked of the quits, how many of them were job to job as opposed to just quits. And in manufacturing and something else, transportation, I think, there was a big gap between the quits. Quits were much higher than the job to job. In leisure, almost the same. So everybody who was quitting in leisure, they were shifting jobs. And that's what's going on, in my judgment. And the government helped by providing this additional money to stay at home and search for a job. People were reevaluating, reassessing, and reallocating their, saying, I really wasn't happy in my job.
I like staying at home more though.
No, but I had reading stories about how when surveys are done, people are finding jobs that have better benefits, better environment,
Sure,
nicer place, sort of intangible sorts of things. They had an opportunity to look for it, and they quit their job and took another job. So they didn't quit just to quit. They quit to find an alternative. I won't say career, but alternative occupation.
So why I think it's more of an issue, and clearly I didn't live through the 70s or 80s, is that yes, a portion of U.S. consumers have reallocated jobs and gotten a higher wage or more fruitful benefits. But at the end of the day, even if year-over-year change of inflation is only 1%, they're still paying 8% higher in prices, even though their wages aren't keeping up with it. Now, you said you're going to be on local news tonight about the minimum wage going up here in Nevada. So there can be a boost there. I just think that until you actually have prices go down on a large scale, you're not going to really solve the problem of what we've got right now.
Well, we know some prices do go down. Food prices do go down.
Sure.
And
we started to see some of those commodities roll over already.
But other prices don't go down typically. Once they go up, they sort of tend to stay up. And that's what because I didn't answer the question. I'm still not going to answer it about the persistence.
Yeah.
So
it's okay.
It's those prices that tend to go up and don't come down.
Yeah.
So they're the Keynesian mindset, sticky prices. Sticky in the downward direction. But the other prices are not sticky. And that's what the Fed, I shouldn't say that's what the Fed is trying to eliminate, the cyclical movement and capture the trend or the persistence, because they want to control the persistence.
How do you think history will judge the current Fed president? More like Volcker, or?
I have a better answer for how I think history is going to judge Biden. The poor guy is wrong place at the wrong time.
Right. It's
at the wrong age.
Yeah. At the wrong age. Yeah, it's tough, right? I think that people mostly vote with their pocketbooks, but there's a lot of ways for people to vote, with their heartstrings. So it'll be interesting to see what happens in November in this midterm election year. I kind of wanted to finish up talking about treasury yields. What's really surprised us here at our firm and why it's been a challenging year, like I told you before we started shooting, is that even the safe money, right? The safe money, the bond portion of people's portfolios, I think the ag's down 11% or so for the year. And if you go longer out in the duration of those bonds, it's obviously even worse.
But the bonds are not necessarily safe, right?
Yes, but it's just,
most people do.
60-40 allocation. Hey, this is the safe money over here. Here's the risky money. It's just something that's said a lot in this industry, unfortunately. But, we look at treasury yields and we've seen how high they've actually gone in comparison to the long trending curve of declining interest rates. Where do you think treasuries start to peak out over, the next 6 to 12 months? Have we seen it
maybe
already?
We've seen the peak already and we won't know it for another few months.
Yeah, it depends on the inflation rate, largely, I think. Those rates eventually have to cover the inflation rate.
Yeah, and you were saying you think that there's a higher probability that you're going to start seeing it actually come down. So maybe we have seen a peak in treasury yields. That's interesting.
But it's not only the inflation rate, it's what the expected inflation rate is over the life of the treasury you're talking about. If you're talking about 3 months, 1 year, if you're talking about bills, it's one thing. You're talking notes, it's another thing. But if you're talking about bonds, and we sort of agreed that at the long term end, the expectation of inflation is still pretty close to 2%.
Yeah, I know. Inflation persistency, it's something that we would like to have an edge on. We don't really know, but if I had to take a stab at it, I would say like having energy prices up and having a undersupply of energy commodities is a huge problem as long as it goes on because the prices of energy are in everything, not just moving things around, but making things. And in the kind of green society that the people are trying to steer us toward,
But the markets
You know,
work.
a lot of people don't, they don't think about that so much, like how much you need energy in, like, even in agriculture, like not just to move things around, but to make the fertilizer that then, grows things that like go into everything. So I feel like we're gonna have elevated inflation for a while until that, even if we look at year over year and you say, well, we're going to start to annualize larger increases in inflation. As long as energy is significantly up year over year, we're probably going to continue to have higher CPI numbers, or elevated anyway. But it'll be a real interesting next month as everything comes out and we see what happens. Today, the Atlanta Fed's GDP Now real-time GDP forecasting indicator was -1 for the second quarter, and so we'll see how well that matches up with the official number at the end of the month.
Yeah, you've been doing this a long time, and I don't know if there's been a time that you've had a technical definition of a recession. I know there's two ways to classify the technical definition of a recession, but the two back-to-back quarters of negative GDP, if we want to use that one, with unemployment at 3.5%.
No.
Never.
I would say that the markets do work, and the amount of energy per unit of GDP that we use in the United States has gone down dramatically from the late 60s and will continue to do so. Maybe the big challenge right now is conversion to non-fossil fuels.
Right, and that's a big effort.
We got plenty of desert out there. Hey, thanks for joining us today. I really appreciate it. Everybody, this is Making Sense of Wealth. Remember, if it don't make dollars, it don't make sense.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.